Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, May 30th, 2025. S&P 500 currently sitting at 5870. I'm David Zarley, and I'm here with Muchacho Kevin Ferrari. Great to have you back on here.
Yeah, thanks. Been a while.
It has been. I should have looked up before we pressed the record button the last time you were on, but maybe you could find some buyers for the market to keep it above a 200-day moving average.
Yeah, I don't know if I know that many people, and the ones I do know, I don't know if we could put the money together to really make that happen. I guess you never know.
Could you be like a town crier and just go up and down the streets with a bell? I don't know.
Probably get the cops called. That's fine.
Well, you don't have to do it at 1 a.m.
That is true.
You could
probably get the most people to respond to that around.
I suppose even at 1 p.m., little suspicious to have a guy walking up and down the street ringing a bell, asking for buyers. But yeah, not too different of a price level for the S&P 500 from last week's recording to now. Still above a 200-day moving average on the S&P 500, which is good. Mm-hmm. But we have some things getting into some interesting areas where you could see supply take control. Is there anything that you're looking at that's kind of piqued your interest?
Yeah, really, there's a lot of things. I guess probably the one that kind of stands out the most to me is probably VEU, just because of how strong international's been lately over the last few months.
Okay, so VEU, the All World Index, subtracting out U.S. stocks. Mm-hmm. And where are we sitting with that? Are we all-time highs?
Well, I guess that depends how you look at it.
Okay, I'm listening.
Currently, if you go off of like daily or weekly all-time highs, not so much. It's right there. As kind of the minutes go by, you're kind of back and forth. If you use the close for like a monthly close, still hard to say. I would think we're going to get that all-time closing high on the monthly today. Knock on wood. You never know, they could trash it from here. But it really kind of depends on what time frame you're looking at, whether or not you really got it.
Well, yeah, in May of 2021, the monthly close for VEU was 64.21. Mm-hmm. We're currently sitting at 65.03. Mm-hmm. And then you look back even further in time, and we've got VEU closed October of 2007 at, what is this? This would be 63.49. So we're right there.
Right there.
And I hope our listeners, the first thing they think about is, wait a minute, that's almost like a 0% return since 2007. And you'd be correct. Like it's about a 2% return. So you can't sit there and say too far, too fast for international all world stocks.
Not by any means.
If since 2007, you've gotten a 2% return and nothing but heartburn in between. Mm-hmm. But to your point, we're not clear out of there on a weekly or daily basis. And I think it brings up a good thought question. Do you have an opinion on this, whether monthly closes or weekly closes? Because I think it's pretty fair. You and I would sit here and say that a weekly close is more important than a daily. Mm-hmm. Can we extrapolate out and say that a monthly is more important than a weekly? Is it that easy?
I feel like that's harder to make that. I don't know. Like once you get beyond weekly, right? Well, like with using monthly charts, I guess personally use them as, more so like I would have to use that with the weekly together. I don't know. Again, some of these monthly charts really can rely on that time frame by itself.
Yeah, I think that's fair, because what's interesting about weekly is the willingness to hold risk over 2 days without price action. Whereas monthly, you might not have that. Now today's the 30th of May, which just happens to be, there's not going to be another day in May, and it's going right into a weekend. So we are going to have 2 days of risk to hold stocks through. And I think that's really a nuanced thing to consider, is that it's absolutely cool if something like VEU closes a new monthly all-time high, but not all months end on a Friday.
Right.
I don't know why the Gregorians or whoever invented this calendar, I know there's various ones out there, how they decided when months would end and how that works. But all I know is that there's months where the month end is on a Wednesday or Tuesday, and you're not carrying that 2-day risk like you would weekly. And using VEU, your point is simply, there's a weekly or a monthly potential for a new all-time high. But when we look at June of 2021, we're right there. Like we may not close above that. That's at 65.10. So it's close. And there's a lot of things like that. It's not just VEU. I know we're focusing on that, but you look at,
there's a lot. I mean,
yeah.
You were talking kind of FANGs before.
Yep.
You were talking about that yesterday too. Right around all-time highs, kind of pulling back from there a little bit. Industrials, XLI. I think yesterday we were talking like uranium as part of like some of these areas in energy and industrials. Kind of the same deal. Up at all-time highs, kind of running into some resistance here so far. Even, which I guess makes sense because we're talking VEU, but a lot of, when you break out international and look at like a lot of your individual country funds, kind of starting to see the same thing. So, I mean, there are quite a few areas of the market that are really kind of pausing up here, which makes sense. I mean, it definitely wouldn't say it's not natural, but it makes you wonder, do we have what it takes to get through there? Or is this kind of foreshadowing that we're going to kind of rein it back in here for a little bit and kind of digest some of this stuff?
Well, yeah, I mean, if we just use like the S&P as an example, this area between 5,800 and 6,100, I mean, that's price history that goes back into late summer of last year, early fall, that anybody who bought there is now getting back to even. And that's a psychological barrier, right? Like I'm back to even, I'm out, like just happy I got my money back. So now is there enough demand to chew through those individuals who are sitting there just getting back to even? That's really what we have to wait and see for now is whether it's VEU or the S&P 500 or FANGs or even a big stock like NVIDIA, which is up against price levels that it's high point or range that goes back to summer of 2024. It's an important psychological level. I mean, there's going to be sellers here. Now, can we chew through that? Can we, like a sledgehammer, can we keep pounding on that wall until we break through? Wish I could tell you, Kevin.
I know. You don't know until it happens, right?
Right. I think the first step would be able to sustain trade above a 200-day moving average for a lot of these things while it's chewing through. But I could also see a scenario where there's aggressive selling in here and it takes us below a 200-day, and then we got to regroup and confirm that the buyers from the April lows were there. I mean, markets do what they want. I wish I could tell a market what to do. I could see a consolidation here, but I could also see a scenario where we're going and seeing whether April was for real, or maybe in 2 weeks we're talking about fresh all-time highs, which is the most bullish thing the market can do, and the sellers were not willing to sell; they're okay holding, and we move higher.
For sure.
From a monthly candle perspective, since we're getting fresh ones, any interesting ones? I know you mentioned VEU, the ones that you're.
I mean, I think this one really is kind of nice. Daily, weekly, monthly, like aerospace and defense looks really good. Yeah, it's like a really solid monthly candle. I mean, that's pretty pristine looking. And even last month's candle, which looks like most things, but just how well that area as a whole is held up is really nice. So I guess that's kind of cheating, I guess, because pretty much every way you look at aerospace and defense, no matter what your time frame, it looks pretty good.
Yeah. You look at something like ITA versus the S&P breaking out of a 5-year base.
Yeah.
And then I think even looking at the aerospace and defense gives us clues about international as well, because, you have your ITAs, your PPAs, your XARs. These are ETF funds that probably are a little bit more US centric, but then you have something like Shield, SHLD, which is outperforming those, and that's more internationally focused.
Mm-hmm.
And I think you brought up before we got on here some interesting points about airlines.
Yeah. So what is AIRL? It's like an airlines ETF that's tilted more towards international, which if you compare that to something like Jets, which is kind of the inverse of that, more US centric, looks quite a bit better. And I mean, I wouldn't say they'd look as good now necessarily. Like global infrastructure using like a GII. I mean, that's a pretty nice monthly candle there.
Yep.
So, I mean, yeah, we're still seeing those things with like the international tilts. They're looking pretty good yet for the most part. So, and I would say, I mean, we talked VEU, but even the relative to the S&P, like that, if you look at that on a monthly, kind of using like that downward rate of trend from, we'll call it like basically start of Q4 2010.
Yep.
That's kind of been continually tested right over the past 15 years. And this month doesn't look like we're going to get a monthly close above there. The kind of intra-month, we've kind of pushed the boundaries there, and even last month as well, kind of closed right there. So we're really kind of trying to break that relative downward rate of trend.
I mean, it's been 15 years of a downward rate of trend, upper left to lower right. And you're right, we haven't broken that rate of trend, trying to now, but you could see if this doesn't work here, rotation back to the U.S. Doesn't have to happen.
No.
And maybe this needs time to consolidate too. So and if there's going to be opportunity internationally, there's still plenty of time. It's not like the train has left the station and you'll be late to international. I mean, we are talking about VU being in a 73% drawdown as opportunity cost versus S&P for the last 15 years. So still plenty of opportunity.
But yeah, if you look at a lot of these individual country ETFs though, I mean, we've had some pretty aggressive moves to the upside to get to this point. I mean, it definitely would not seem to be, like, it would seem constructive if we consolidate here and digest some of this, which would be nice. I mean, that does, right? Because really for a lot of these areas, it's pretty tough to kind of jump on that bandwagon because once it took off, it pretty much took off.
Right.
I mean, there were some areas in there where you kind of had time to get in, but, if you kind of missed that boat, we consolidate here. I could just provide more opportunity, right, to get into the upside later.
Yep, 100%. It's really hard to get bearish equities overall if something like Germany continues to make new all-time highs.
Yeah, Germany looks really good.
Germany versus the U.S. looks like it's trying to work on break out of a base that goes back to 2021. Also in a downtrend since 2008, but I mean, pretty constructive, highly correlated to U.S. markets is the German DAX. So we'll see here if they can pull this off. And on the flip side, that'd be one in the positive category. On the flip side, you have broad-based semiconductors using something like XSD versus the S&P not looking too healthy. So you could see a scenario where will they sell again here and take us back to the lows? Possibly. I mean, we'll know that by crossing below levels. I think it's interesting how many gaps in price exist in the S&P 500 around these levels. When you look at daily information, right, we're still holding the election gap, which sits at approximately 58.60, 58.66. We're still holding that. There's a gap from earlier in this month there. There's a gap from this recovery in early May to get above a 200-day. There's a gap near 56.74 from last year. So it's just interesting how this really important price levels here that we're wrapping around to see. And that's all this is studying the interaction of supply and demand. It's nothing earth shattering. It's just seeing where the buyers and sellers meet. And if we can stay above a 200-day and hold the election gap, the January 1st price is right here as well. I mean, we're talking, I shouldn't say January 1st because technically the 1st was not a trading day. Well, we're right there where we were on January 2nd as far as price is concerned on the S&P 500s. Yeah, you have all this weight of evidence out there on both sides. You've got broad-based semiconductors versus S&P not looking all that healthy. Yet you're seeing strength out of international. You have something like JP Morgan versus the S&P trying to break out of 3-decade-long base. And you can't get too bearish if JP Morgan's going to do something like that. But you can't get too bullish if semiconductors are selling off.
Right. Well, that's what it feels like most times, right? You keep getting these mixed signals. in certain areas. And I mean, like with banks, like even globally, banks are looking pretty good. I know GSIB is one we've used before. That has all those larger international banks. That's holding up pretty well. And even insurance, and I guess probably more specifically towards like the property and casualty side of that, still holding up pretty well too, which is nice. They've been pretty consistent for the most part over the past couple months.
Right.
So, I mean, that's good to see.
And you brought up global infrastructure, aerospace and defense, globally systematically important banks. I mean, it's really, we're not sitting here saying, oh, it's staples, it's utilities. It's not these safe havens that are leading the way. But at the same time, it's not all boxes checked, which it almost never is. Right. And sometimes there's more boxes checked than others. I mean, for most of 2024, a lot of boxes checked, especially after the breath thrust we saw in October and November of 23. And we still have the backdrop of this big breath thrust that happened in April, first part of May. And at the same time, in a short term, so that's more intermediate term, weeks to months. In the near term, just a week or two ago, high percentage of stocks with a RSI reading above 70. So a little bit of pullback and cooling off here for the next few weeks makes a lot of sense. So we'll see. I feel like I say that too much, but it really is. It's a Bayesian.
Right. I mean, it's
a Bayesian approach to statistics is you wait for the information to come in. And so it's kind of one of those things where you're positioned for risk, right? Because you're above a 200-day moving average. But is your foot like all the way down on the accelerator? Not necessarily. This isn't the time to fly 80 down the highway. There's still some construction barrels on the side of the road worth paying attention to. What else? What other things are you looking at? And you could take this anywhere. You can go bonds, commodities, crypto. You could stay on stocks. Doesn't matter to me.
I mean, in the commodity front, there's really not too much going on. Like the egg space, really, it's still just kind of cattle. And it still looks really good. But like all your grains, things like that, outside of like canola, really not showing much life there at all. I know you were talking about oil before. Still can't really get above $64 a barrel. It's pretty quiet on the commodity front, I guess, unless outside of like your precious metals. Because I mean, really, gold and silver have been holding up fairly well.
Yeah, I think that's
kind of interesting.
Yeah, I think that's it's been consolidated. It had such a strong move since breaking out of a base in 2023 and then another consolidation in 24 that it would consolidate here. It wasn't too many episodes ago that in April that we talked about, is this really a great place to take on a new position in gold? Probably not. But I'll say that this consolidation in gold for the past month and a half has been extremely constructive. And does that move higher, especially if a trade weighted dollar is going to remain below 100? Probably doesn't hurt.
You wouldn't think so, right? I mean, yeah, the dollar. I mean, it'd be interesting to see what the dollar does here. Definitely, you would think would give us a little bit of an idea, maybe what to expect looking forward. But
Bitcoin too. Bitcoin's exposed to the dollar, and it's trying to hold the highs from 2024. We'll see if it can do that.
No.
But materials overall, not that great. Gold and silver miners, even some of the copper miners holding up okay.
Yeah.
And I would call those at inflection points, especially if you look at something like a copper gold ratio at levels that we haven't seen on the bottom side since the COVID bottom or the financial crisis bottom. So it'd be really interesting if that turned a corner here. So a lot of things at an inflection point, whether it's on the top side, meaning like potential resistance, but also on the other side, potential support. And you've got Germany doing well. You've got Japan holding up, the yen holding up pretty good. So mixed signals, but I think you still tilt in the favor of the primary trend being up as long as we're above a 200-day moving average.
Yeah, can't really argue with that. Really at that point.
Anything else in the commodity space? I know you mentioned uranium. Is that another one of those at an inflection point?
Yeah, kind of up against all-time highs in a lot of those ETFs. If you use like as a URA, or I shouldn't say all-time highs, but like a recent, highs kind of going back to 23, 24, kind of back towards like 2016-ish, 2015, kind of getting rejected there as of now. So we'll kind of see what happens there. No, other than that, in the commodity space, pretty quiet. I mean, unless you get like coffee, I guess has been one that's performed pretty well for a while. This kind of more of a, I guess, short-term low, I guess. But if you look at coffee futures, kind of around this, call it like $3.40 a pound, roughly in there, maybe even like 3.25, kind of like, I guess, like it to hold that if that's kind of your thing. And I mean, that's even one too that's been on quite the run. I guess it would kind of builds a range here. I don't think that would be kind of the worst thing in the world.
You buy your coffee in pounds? How does that work? I'm not a coffee drinker. How is that? You buy a package of coffee, typically ground up.
No. I guess I don't even like your average bag of like coffee grounds. I don't even know what the weight would be. I don't think it could be a pound. That would be, it seems like a lot, but maybe, I don't know.
Just don't buy it is what I say.
I don't even look. I mean, that's the thing. It's almost better not to look when you're at the grocery store because more often than not, you're going to buy it anyway. So yeah, I try not to think about it too much.
Do they sell coffee in tins, like tin cans? Is that still a thing?
I mean, I'm sure you can. I guess I haven't seen it, but I'm also not a connoisseur by any means. I mean, I'll pretty much drink just about anything.
Coffee will do.
Mostly if we start talking like jungle cat poop coffee, then I'm kind of out on that. That's not really my forte, but yeah, I don't even think I could afford it actually anyway, even if I wanted to.
Is that like a prerequisite for like the person who's serving that has to like give a warning? Like, hey, just so you know, this is jungle cat poop coffee.
I have no idea. Probably better off if you don't do that. I don't know. Maybe then you can probably charge a higher price for it, right? With a little bit of extra processing required.
Fascinating. Mm-hmm. The coffee culture. America's definitely a coffee culture. No doubt about it. So we've covered a lot of ground. I always like to pause and highlight the supporter of this podcast, the Adaptive Select ETF, which is listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. So we didn't talk about momentum this week, which we have been talking about the prior weeks. And I think it's safe to say that momentum is still something in place. When you look at it on a relative basis versus the S&P, another weekly closing high, monthly closing high. So that might be another one to check the box for a bullish scenario if momentum is going to be in play. At the same time, you could see momentum pausing here. It's had quite a run, and seeing that pull back or consolidate. But anything else you want to highlight for our listeners before we close this one down?
Not too crazy, I don't think. I mean, TLT looks like it's kind of trying to find a bottom here.
Went to bonds. That's great.
Right. I mean, rates kind of bumbling around here. Like, I mean, I feel like they have been for a while. So it doesn't really feel like too much going on there, at least as of now. But
yeah, rates using 10-year treasury notes, they haven't gone anywhere since October of 22. So sideways. So quite a move off the COVID bottom in rising rates, but still range bound since late 2022, whether you're looking at 10-year or 30-year yields. And sometimes markets like that, it's not about what the interest rate level is. It's just rate of change, like how much change is there in rates. And we haven't seen a tremendous amount of change since about then. And wouldn't you know, in October of 22 is, you could argue, the major bottom after the last correction in 21, 22, that we've seen rates move sideways. So maybe there's something there that we continue to see rates move sideways, which would be potentially a bullish characteristic for equities, but we'll see.
Yeah, and I think it's nice that like a lot of those risk on areas and fixed income, that's kind of recovered, kind of like mid to late March into early middle of April. A chunk of those areas, like your lower credit quality stuff, like triple Bs, or just junk in general, like convertible bonds, which can be a little bit more risk on, I guess. They've kind of recovered. So, I mean, it's kind of positive to see.
It is positive.
I mean, I don't know if we're necessarily, I guess, quote unquote, out of the woods yet for some of this, because really some of those instruments are kind of getting into some interesting levels. I mean, they got a little ways to go yet. But that'll kind of be one to watch probably here in the next couple weeks. See if that kind of sticks, or if we get in the same scenario we're seeing with some of these other areas and equities. So,
yeah, I think that's fair. I think if you look at junk bonds using JNK, testing up the underside of a 200-day, or you look at junk bonds versus intermediate treasuries at an important level, you look at triple Bs back into a range. You've seen triple C credit spreads cool off. Do you see a resurgence in those? And so now it's about risk management, as always, that if you're seeing equities lose important levels, you're likely seeing some of those things perk up again. Triple C credit spreads moving higher, junk bonds getting sold off. Those would be some of the things you'd see in alignment. So it'll be interesting the weeks ahead. I don't know if we've got a messy summer ahead, or we're just consolidating and it's 3 to 5% moves on a weekly basis until we've chewed through this supply. Time will tell. Anything else, Kevin?
I don't think so.
Okay. Well, I appreciate you filling in. You always do a great job. All the work you do for our clients and for our team, you do a tremendous job. So it's great to get you on here. And with that, I'll ask our listeners, if you appreciate this information, share it with your friends, give us a high ranking on your platform of choice. We really appreciate it.
Thanks. Have a good weekend.